look at answering practice problem number 5. In practice problem number 5, you are given a balance sheet with 3 years of information and an income statement with the same 3 years of information. We're going to look at putting together several of the ratios here listed on the right-hand side. So if you remember, some of the ratios that we're going to be looking at, we're going to need to solve for averages. So it's actually easier if you calculate those averages first. So we're going to need average assets for our return on assets, average common shareholders equity for our return on common stockholders equity, and average accounts receivable for our accounts receivable ratios. And common stockholders equity and common shareholders equity can be used interchangeably. So as you remember, in order to calculate an average, you're going to take the prior year plus the current year. Remember order of operations, put those in parentheses, and divide by 2. So that's going to give us our average assets for 2014. In 2015, we're going to take 14 plus 15 divided by 2, and we're looking at total assets. Then we're going to do the same thing for stockholders' equity and the same thing for accounts receivable. Take them divided by 2. Okay, so here's our averages that we're going to refer to when we calculate these problems. So current ratio. If you remember, that is our current assets divided by our current liabilities. So if we don't have a total of current assets, it's going to be anything that's most liquid. So cash, accounts receivable, inventory, prepaids can be included in there. So we're going to take our current assets divided by our current liabilities. Okay? So this is how quickly a company can pay off their short-term obligations. And we look at 2014 of 1.68 compared to 2015 of 1.45. This company's current ratio has worsened from 14 to 15. Now let's look at the days in AR. First, we need to calculate the accounts receivable turnover. So here, I'm actually calculating the average right here, but instead of calculating the average here, I also could have just grabbed my average accounts receivable from here. Okay, so it's going to be my AR turnover, which is my sales, divided by my average accounts receivable. That's this parentheses here. Then the number of days in the period is 365, so I'm going to take that divided by my AR turnover, which gives me 12.3 days. And then I do the same thing here. Oops. And it's going to give me 11.9. So for 2015, it means that I can collect the cash on my sales within 11.9 days. And this is improved from last year, 12.3 days. So this is really great if they're collecting, if their policy says they collect their accounts receivable, it's due within 30 days. Even if it's due within 15 days, this is great. And it's just continuing to improve year over year. Now we're going to look at our debt to equity ratio. These first two ratios that we talked about are liquidity ratios. They look at how liquid a company is, how easily they can convert into cash. Debt to equity is a solvency ratio. So here we're going to take our total liabilities divided by our total equity. So our total liabilities includes our short-term, current, and our long-term liabilities. So that includes any kind of debt, notes payable, accounts payable, it's all liabilities, and then our stockholders' equity, which could include common stock and retained earnings. So it was 1.14 in 2014 and 1.13 in 2015. It stayed about the same, and it's not higher or lower is better. It really depends on the company's strategy and how much debt they want to finance, how much of their company they want to finance through debt versus equity. Return on assets is going to look at, we're going to divide this by our average assets. We're going to divide this by our average assets here. Okay, so we are going to be looking at our net income, which is here. And remember, we're going to add back our interest expense times net of tax. So it's actually times 1 minus 0.4, our tax rate. And we're going to add those together, and then we're going to divide by our average assets. Okay, it gives us 19.3%. And it's 23.3% for 2015. And this ratio is improved. Higher is better. It means that they earned more income as a percentage of their assets. Then we're going to look at our return on common stockholders' equity. And if you remember, return on stockholders' equity is actually going to be our net income minus any preferred dividends. So in this case, we don't have any preferred dividends, so it would just be our net income of $3,000 divided by our average common shareholders' equity, which we had calculated previously down here. And then we're going to do the same thing for 2015, our net income divided by our average common equity. So you can see that this ratio improved from 14 to 15, and it's the percentage of income shown as a percentage of their equity. So they're getting a high return on their equity. Earnings per share is simply going to be our net income divided by the average shares outstanding, which is 1,000 in this case. So you just need to make sure that these are average shares outstanding. If they're just shares outstanding, then you would need to take, I'm sorry, this is the wrong year. You would need to take the prior year plus the current year and divide by 2, as we've been doing. Okay. And then here it's 4,200 divided by 1,000. And this has actually improved because it went up. Higher is better. So how much income per share of stock? And then we're going to look at our margin, which again is net income divided by our sales. So that's return on sales, or also referred to as profit margin. So that could be used interchangeably with return on sales. Okay. That's 1.2 versus 1.6. Higher is better, so it's the net income per dollar of sales. It's a pretty low profit margin. And then total asset turnover is going to be your sales divided by your average assets. And higher is better, so we've improved here. It's the amount of sales generated for each dollar of assets. And then ROI is simply our net income divided by our average assets. And if you take your profit margin times your asset turnover, it'll give you the same percentage. Okay? It's when you multiply these two ratios together. And that has gone up, so it improved as well. It's the return on your investment, the return on your assets. And then our residual income, if you remember, is your net income minus your average assets times the required rate of return. So remember we talked about this. If your ROI is higher than your minimum rate of return, then you will definitely have residual income, which we can see here. If this number here was below our required rate of return of 10%, then it would be lower or negative. Okay? So hopefully that answers your question on problem number 5 on how to do that and solve for these ratios.